We begin with the Fed, as we are less than 24 hours away from one of the biggest Fed decisions in years. So is another rate hike on the table, or will the collapse of Silicon Valley Bank and problems at other banks cause the Fed to pause and wait things out just a bit? Here now with some insight, Frederic Mishkin, former Federal Reserve Board governor and economics professor at Columbia University. Professor Mishkin, welcome. Good to have you with us. What do you think the Fed will do tomorrow? What do you think they should do?
Well, let me tell you where I stand on this. I've been quite hawkish. In fact, I've been taking the view that last time they should have done 50. And in fact, I was pleased that Jay was talking about 50 and think the Fed really has been a little bit behind the curve and has to keep on moving and moving rapidly. But I have to tell you, my views have changed right now. We're dealing with an issue which is frequently referred to as financial dominance, which is that if, in fact, the financial sector becomes very unstable, then, in fact, the Fed raising interest rates will just make the instability worse. And so, in a sense, the central bank gets put between a rock and a hard place. And that's really the situation the Fed's in currently. I think that actually situation is going to resolve. I think there's steps the Fed can take to resolve it. I can mention a few. But I think the Fed right now wants to basically just let the markets calm down. But it needs to make a very strong commitment to say that we think that this is going to be under control. I'll talk about some of the things I think they can do to do that. And when we see that it's under control, then we actually have to get back to our business of really tightening monetary policy and tightening quite a bit. And really start moving back to bigger changes, 50 basis point moves till we get to where we need to get to, which I think is probably in the range of 5.5% to 6%. So what does the Fed need to do? The Fed really needs to actually go into the banks and actually do stress tests right now on their interest rate risk. In fact, there really has been a failure of regulation on this. I'm a little bit surprised by it because the Fed is supposed to monitor risk management in these firms. And interest rate risk is actually one of the easiest kind of risk to calculate. This is not rocket scientists. It's banking 101. I have it in my textbook on money and banking, which is used by undergraduates and also business students. It's basically very, very straightforward stuff to do. It hasn't been done. It now needs to be done. And in fact, the Fed has to let the public know that, in fact, if a bank doesn't has too much risk, they need to be dealing with it or to borrow or recapitalize. But in fact, I suspect that most banks will be okay. So the Fed really needs to say we're going to get on top of this. And when we get on top of this, then we've got to get back to business.
So implicit in what you're saying, Professor,
where they haven't really led to full-scale banking crisis in the 1990s, and the Fed was able to tighten and keep inflation under control. So they've got to basically express that, signal that very strongly right now. But I actually would pause right now to let the market settle down. Not a crazy thing if they do it 25 basis points and indicate that they're watching carefully. But I might be a little bit more conservative. And having been traditionally quite hawkish recently, I actually now moving a little bit to the conservative side, but to indicate that the Fed really needs to do its business as soon as we get this straightened out.